Hello and welcome back to the Note, and I'm afraid it's more of the same. Very significant sell-offs for world stock markets, with the significant exception of Japan today, and big selling into the close here in Wall Street, which is always a bad sign. Indeed, if we take a look at this chart, you can see that the Russell 2000 of small cap stocks is now in a bear market. That's where you define by the classic arbitrary definition any fall of 20% or more from a peak as a bear market, while any fall of 10% or more is a correction. You can see that on the same basis, the Russell 1000 index of large cap stocks tends to behave very similarly to the S&P 500, is itself in a correction now, and while the mega caps are doing a little better than that, plainly you would not be very excited by their performance of late. A number of the very big leading stocks of last year have been among the biggest losers in the last few days. Now, this leads to the question of whether we are really tipping over into a bear market. I've given various reasons to fear why we might be in recent days. Let's take a look at the lessons from history. If we take a look at this chart, which is the S&P 500 in real terms divided through by CPI over the last 50 years, you'll see rather intriguingly that in real terms we still haven't ever surpassed where we reached at the top of the internet bubble back in 2000. But one very great source of hope is that in the last 30 years, there have only been 3 bear markets that were not also associated with a recession. And in all 3 of those cases, they're barely visible on this chart. So quickly were they corrected. For the record, that was in 1987 after the Black Monday crash, largely caused by the stock market simply getting far too far ahead of itself. In late 1998, caused by the long-term capital management meltdown, corrected within a matter of weeks, but did fall more than 20%. And in 2011, when you had the debt ceiling crisis here in the US and Standard & Poor's decision to downgrade US sovereign debt. Again, the fall was barely over 20%, and we were back to the previous highs inside of a year. The argument many people make, and it's a valid one, is that unless there is a recession, bear markets tend not to go too much more than 20% and tend to correct themselves back fairly quickly. In terms of signs of a recession here, yes, manufacturing in this country is in a recession, but it's only about 12% of the economy. Beyond that, there is not a clear sign of a recession yet, and that is the strongest hope that we can indeed somehow avoid a bear market.